Hello and welcome to Money Life News and Views. I'm Debashis Basu. The US-Israel war on Iran has entered the fourth week and the Indian benchmark indices are down by about 8%. The first order effects of the war are all very familiar to all of us, with the Strait of Hormuz effectively closed. Of India's imports, roughly 54% of crude, 60% of LNG, that is liquefied natural gas, and as much as 90% of LPG comes through Hormuz. Along with oil and gas, India faces a shortage of refined products like naphtha, aviation turbine fuel, and gas oil. The deeper vulnerability lies in food. Food production depends on diesel and fertilizer. Diesel runs tractors, irrigation pumps, and transport system that carries crops. Fertilizers, which includes urea, ammonia, and phosphates, determine yields. More than 30% of global urea trade and roughly 20% of ammonia and phosphate pass through Hormuz. The Gulf region is also a critical supplier of more than a third of global helium, a niche input which is indispensable for semiconductor and imaging machines. It accounts for around 30% of global methanol production, a base chemical for plastics, paints, and fuels. The Gulf also dominates sulfur exports, about 45% of the global total, which feeds directly into fertilizer production. Even aluminium is affected. The Gulf produces roughly 9% of global output and accounts for 22% of supply outside China, leaving Europe and America exposed in sectors from automotive to construction. Investors now have to decide how much of these effects are already priced in as the war rages on. Consider aviation fuel, which accounts for 35 to 40% of the cost of running an airline. A 10% increase in fuel price can cut operating profits by around 15%, according to analysts. Add to this the complication of West Asian airspace closures and longer flight paths, and their margins erode further. Already certain countries, such as Philippines, are saying they will have no flights coming in and going out, and even countries like Vietnam and other countries are very worried. In consumer goods, the pressure is more diffused. Crude-linked packaging materials, that is PET chips, liquid paraffin, HDPE, and flexible laminates, these account for roughly 15% of operating costs, according to analysts. Larger firms with pricing power can pass some of this on to customers. Smaller, unorganized players cannot, accelerating a shift in market share. Then comes glass production, which depends on natural glass. Textile producers rely on intermediates. Disruptions have already pushed polyester yarn prices by about 15 to 20%. Cement avoids direct supply disruption but still suffers from price effects. Increase in fuel costs can reduce earnings, with an additional hit from higher polypropylene prices, which are used in packaging cement. Tile producers in Morbi, Gujarat have already shut down due to lack of gas. Each of these is a small cog. They're separate. Together, they form a system which is bound to be affected by time and price. Over the past few weeks of shortages, very little has appeared amiss, but once inventories start running down in 1 to 3 months' time, replenishment will come at a sharply higher cost, triggering a bigger hidden shock. Question is, how much of all this is priced by the market? Well, till now, the market thinks that very soon, all of the problems will be over. Either Iran, either Israel or US will back down, or they'll force themselves onto Iran, and probably that's the resolution that the market is betting on. Markets react quickly to first-order shock. Equities wobble, currencies weaken. By nature, investors are optimistic, so they tend to assume that normality will return soon, as I just mentioned. The second and third order effects are less visible. The broader fiscal arithmetic, the effect on consumption, are treated as secondary concerns to be dealt with as and when they happen. Now, every $10 rise in crude adds roughly $12 to $15 billion to India's import bill. A sustained oil price above $80 risks pushing inflation beyond 4.5%, widening the current account deficit towards 1.5 to 2% of GDP, and weakening the rupee potentially past 95 to the dollar. Capital flows will slow down at a time the rupee is weakening, and foreign portfolio investors, as we know, they're already selling a lot. A bigger issue on that capital front, out of 130 to 135 billion dollars in annual remittances, India gets some 45 to 50 billion dollars, almost 38% comes from the Gulf. Even a 10% decline would shave off inflows of 4 to 5 billion. The biggest impact will be a worsening trade balance, higher inflation, widening fiscal deficit, and lower tax revenues. Higher fertilizer costs raise subsidy bills. Because obviously, we don't expect the government to allow a price rises across the board. So much of the impact will be absorbed by the government. Shortages risk lower application by farmers, which in turn threatens yields. Governments can absorb some increases in fuel prices, but absorbing both fuel and fertilizer is much harder. At oil prices above $100, the fiscal cost of subsidies and tax cuts can exceed 1% of GDP, says one estimate. Add fertilizer support to that, and the burden rises further, and the deficit simply goes haywire. In response, the government will cut capital expenditure because there is no scope to cut revenue expenditures, all salaries and interest costs. So the first thing the government will do is to cut capital expenditure to maintain fiscal balance. Now, government capital expenditure has been India's main growth engine in recent years, remember. So that means a slowdown led by lower fixed asset formation. If the war continues, we will see a vicious cycle emerge. Energy drives fertilizer costs, fertilizer drives food prices, food drives inflation, inflation feeds back into energy through currency depreciation. The rising costs from dearer fuel and fertilizer will leave thousands with less discretionary spending, and tax revenues will go down. The system can absorb shocks in the first few weeks. We have seen that. Beyond that, that is from the coming week onwards, the problem will appear through small changes here and there, a few percentage points off at the margins, a few weeks of delayed production, a few basis points added to inflation, and so on. Each time something like this comes to the in front of the market, in the eyes of the market will react. And because these changes will unfold slowly, they are easy to underestimate. So I would say until there is a quick resolution, more bad news is likely to come, interspersed with hopes of a resolution. So it's going to be a bumpy ride. Thanks for watching. And if you did like, do share and subscribe.